my students. Welcome to JMC V-Learning. Today, it's grade 10 Business Studies and Accounting session. In a business, there are different types of transactions in different values, in different natures and different bases. Therefore, for a business, there should be a method, an accepted method to record these transactions. So, to record these transactions, there should be method because we have to report or record transactions to present to our stakeholders for their decision making purposes. So, the transactions or details information we present to our stakeholders should be complete, accurate and timely basis. Timely basis means we have to provide for the exact time period they are asking. If they are asking accounting information for an year, we have to provide accounting information for a year. Like that. So, how can we record these transactions? To record these transactions, there is a accepted method. So, in a business, transactions and events are taken place. Transactions and events. When a transaction or an event takes place, there is a document, a special place that the evidence, proof of this transaction is recorded. Think like this. When you are going on a bus or when you are purchasing something from a shop, let's say a supermarket, what do you get? When you are paying money with the goods, you are receiving a receipt mentioning what are the things you bought, how much those cost and the amount you have to pay. With those things, the date of the transaction, the time, the cashier at that point, those information are included in that receipt. When you are going on a bus, the conductor is issuing you a ticket, a bus ticket. In that ticket, you have your place you got in and your destination, the cost they charge for that distance and the time and the bus number. Those details are the basic details to us to know that this particular transaction took place in this particular place, in this particular time, from this particular value. So, such type of document, such type of a written thing, a printed thing, an electronic thing, we call a source document. A source document or an original document. Transactions and events are recorded, actually not recorded, are reported. We are just writing down or printing down what is the nature, amount of that transaction in this particular document. We call that document a source document or original document. Original document. Why? This original document or source document, that means this document is generated at the origin of the transaction. When the transaction is originated, this document is generated. When you are purchasing goods and services, when you are getting the service from going by the bus or your Uber, anything. So, this source document or original document can be exist in three ways: written, printed and electronic. Written documents when you're going to your village grocery shop, when you're purchasing like milk, powder, sugar, some few items, your trader in that grocery shop writing down the items you purchased and the amount of those items. Then he collects it and he tells you, you have to pay me this amount. So he is writing it by hand. And some of those textile shops and payment shops, we see this method. They are writing down the transaction, the amounts you purchased, the quantity you purchased, and they give it to you and they ask from you the money. So the printed ones in supermarkets, bus tickets, those things are printed ones. And electronic, when you pay something online, you get the electronic source document. It can be an email, a text message, or anything that can be viewed on a screen other than printing or writing. Electronic method. So, source documents are the things or documents that record the original details, the basic details of a transaction or an event that taken place somewhere. So, it can be exist in written, printed and electronic forms. So, after these source documents, this documents always consists some common details. Some common details such as date of the transaction, amount, basis, that means whether credit or cash. We can make credit sales or cash sales, either ways. So they mention whether it is credit basis or cash basis. And buyer, seller, those parties who engage in the transaction, and those basic things are mentioned in the source document. And sometimes you might have seen source document consists of some serial number or sequential number. That is for the issuing purpose. So we know this source document is issued on this date, on this order. So after this source document is generated, we extract this information from this source document to another place. Now we can't paste all the receipts and vouchers in our books now. We are doing thousands of transactions sometimes in a business. If you are a large scale business, there are thousands of hundreds of transactions per day. So you can't paste every receipt you get in the books. Then that will be a disaster. So for that, for our convenience, to avoid that complicatedness, we extract these basic information from the source document and we move it, we record it in a separate place. This place is the first place we record these transaction information in our accounting system. So this place we call it prime entry books. Prime entry books. These prime entry books are also known as day books or books of original entry. So books of original entry means this original document has generated these details. So these details are extracted from here to this particular place, prime entry books. Therefore, the details of a transaction first recorded in the source document, then we extract those transaction details to prime entry books. So, prime entry books, you have to remember the first place to record this information. And here, we are not recording it according to the double entry system. There is just a record of this transaction. So, before we enter this transaction details into double entry system, we record and we sort it out. We classify it according to our basic accounts in this particular place. Where is it? The prime entry books. Some examples are there. I'll show you. Transaction. The very familiar, very common transaction is cash receipts or payments. Cash receipts or payment is the very familiar transaction for us. So, the source document, the first place, the origin of this transaction is in this source document. For cash receipts and payments, there are two types of source documents. Cash receipt and payment voucher. When you receive cash, you record in cash receipt, and when you pay cash, you record in cash payment voucher. So these payment vouchers and receipts are also share this basic information, that means the date, amount, basis, to whom we paid. The date we made the transaction, how much we paid or how much we received, and to whom we paid or from whom we received, on what nature, that means it's a large scale or small scale, whatever, we have to record these basic details in these source documents. So, for cash transactions, cash receipts and payments, the source documents are cash receipt and payment voucher. The prime entry book, the first place to record cash transactions, you already know that, the cash book. The first place to record cash transactions. So, when we talk about credit purchases, credit purchases, we purchase goods or services on credit basis. So, if we purchase on credit basis, credit purchases, the source document we call purchase invoice. Purchase invoice. That is also very similar. These source document formats are very similar because each and every source document records the same details, the same, almost same basic details. Therefore, these source document formats are very similar. Purchase invoice is the source document for credit purchases. And the prime entry book, the place you record first, is purchase journal. Remember, in purchase journal, you only record credit purchases. You only record credit purchases. You can't record cash purchases in purchase journal because cash purchases we already post into cash book because it's a payment of cash. Therefore, payments of cash we have to record in the cash book. And credit purchases is like that. Then credit sales. Credit sales. Credit sales also has the same name. Sales invoice. The source document is sales invoice. If you search for a format in Google for a invoice, for format of an invoice, you can get various types of invoices and these receipts or payment vouchers. But you will be able to see the basic details are available. Almost all of them are common. So, for credit sales, the source document is sales invoice. Prime entry book is sales journal. This is like a diary. Prime entry books are almost like diaries. We just record on this date we received this much of goods. On this date we sold this much of goods to this person. And cash book also same. It records debit and credits. On this date we paid this much to this person or we settled this expense. And we received this much of cash on that date from this particular person, a debtor, a bank loan, like that. So it's like a diary. We record what happened on this date and how much is it. So these are three basic examples for transactions and relevant source documents with prime entry books. There are many of these transactions. Basically you have to learn 5 of these transactions and prime entry books. In future lessons we will discuss about the rest of these prime entry books. So after recording in prime entry books we don't stop here. So from prime entry books then only we transfer these transactions to ledger accounts. Now we already know what is a ledger account. It's a systematic or accepted format of recording the dual impact of a transaction. Therefore, after prime entry books we record it in ledger accounts. Ledger accounts. You can remember we learned this T format and this side as debit, this side as credit, and we recorded transactions in our previous session. So now you can see after ledger accounts we make financial statements. So financial statements are the output of the accounting process. So to get that output we have another process inside of recording transactions. Now we'll see from the beginning. Now transactions and events are taken place. So because of that a source document or an original document is generated. From that source document or that original document we have this basic information about the transaction. So we have to provide all the information, all the relevant information to make a decision. We have to provide it to stakeholders. Therefore, we extract these details from source documents and we record it in the day book. According to these transactions, we have separate source documents or separate day books. After recording in these prime entry books or day books, we post it into ledger accounts according to the double entry. And finally, using these details, we prepare financial statements. So, if we take an example, we'll take cash receipt. I receive cash from a debtor. I receive 2,000 from a debtor. The source document is receipt. When a When this transaction is posted here, we record it as the day book on this particular date, this date, from this person, or we'll say ABC company. ABC company is paying me this much amount. ABC company, I received 2000. I post an entry like this, and after that I'm going to ledger accounts and I open up separate ledger accounts. Cash account. I received money, therefore it is debit. 2000 debit. And debtors account, therefore credit because he paid me money. Now here in this particular section, when you are posting to ledger accounts, the double entry completes. And when we are going to financial statements, we record we had debtors 2000, but we don't have any debtors right now. But we have cash of 2000. In here financial statements, I record I have cash 2000. So my stakeholder, maybe my owner, that means the owner of the business, manager, or whoever the stakeholder reading my financial statements knows that I have 2000 cash in my hand, but I don't have any debtors. So this is the simply explanation of the accounting recording process of transactions. But this is a complex process. Now I showed you very simply how it is done.